Hello and welcome to the Prescribing Prosperity Podcast with your hosts, John and Alex Soutsos. Gentlemen, good to see you again. How you been?
Good, Bill. Good to see you too.
Very good. Thanks, Bill.
That's great. It's great. We're going to continue a series that loosely runs throughout all of your podcasts, which have to do with planning for major life events. And today we're getting to that question of retirement. And if we're going to talk about retirement, we have to start with the hardest question of all. And I'm not quite sure which one of you want to take this, but how do you know when in fact you're ready to retire?
Well, considering that of the age that I am, which is I'm over 30, that puts me closer to retirement than Alexander. So I will take on the question. So this is a multifaceted question. When are you ready to retire? Well, there's a psychological readiness of knowing you want to stop working. But there's also the financial readiness issue, and the financial readiness issue is the most important. So where you begin is you make a list of your committed monthly expenditures, and let's say for the sake of discussion, there's two ways of approaching it. You can either try and determine, replicate your current, while you're employed, gross annual income, and target that. To determine what your accumulated value has to be able to support that. Or you can look at your committed monthly expenditures, which hopefully by age 60 or older are well below your annual income. So let's say, for the sake of discussion, you're a medical professional, you're earning $400,000 a year gross, and you would need about 5 times that figure, so about $10 million, to ensure that you don't permanently encroach on capital. You will periodically encroach on capital with that amount. And if you don't care about leaving a legacy behind, you can even have less than that. Although when you have less than that, it usually becomes financially very stressful because you experience periodic capital drawdowns that will create some psychological stress. So to give yourself lots of room, you generally want 5 times your annual income. So in this case, on the $400,000 annual income, you want $10 million. You might be able to start with as little as $5 million. But then we look at the committed monthly expenditure. So let's say you're not actually spending the net after-tax proceeds of $400,000 gross. And again, for the sake of expediency, we'll just say that $300,000 is what your after-tax income is. So let's say you're not spending $300,000, you're spending $200,000.
When you say committed expenditures, before we go any further, what do you mean by that?
Non-discretionary expenditures,
like your utilities, your mortgage, those kinds of things. Okay,
right?
Groceries,
credit,
car
payments. and also. So all the non-discretionary expenditures, most people are going to add in a little bit of discretionary spending in there, like travel.
Okay. Yep.
Of course, especially if you're going to stop working. Obviously, you don't want to sit in front of the TV and watch fake news all day long. You want to be traveling. You want to be participating in life, playing tennis, golf, whatever your activity of interest is. So you want to build in that bit of buffer for spending money. So let's say in this illustration, instead of $400,000, you only need $300,000 gross, and whatever that leaves you on a net after-tax basis.
Yeah, you said 5 times. You should have been 25, because if you're going from $400,000 to $10 million, it's 25 times.
Yes, you're right. So 7.5 million is the number for 300,000. And so 7.5 million. So that's the financial number you need to decide if you're ready to retire. Now, psychologically, different story. If you're a medical professional and you're experiencing burnout, stress, you've had enough of the administrative requirements with all the document filing that's required these days, and you just want to pull the plug and go, then you have to make a tough decision if you're not financially at your target. You have to say, okay.
Pull the career plug, not the life plug.
Well, maybe. It could be. I have a friend of mine who was a surgeon who he never wanted to retire. He didn't want to retire. His partners finally had to, true story, partners finally had to get together and say, it's time for you to retire. So, he was well past 70 and, and then he immediately went out and found another job. So
good for him. Bill, that's not an uncommon occurrence these days. There's lots of people who are fortunate enough to find a job that they love, a career that they love, and find a way to continue to do that career as long as they can. And that's a choice.
And that's exactly the transition that we were going to get into on the subject matter. Is retirement doesn't mean you stop working completely. It simply means you've reached a point that you are perhaps financially independent. You can support yourself on the money you've accumulated. And now it's time to do something you really, really love. And some people want to be a Walmart greeter.
It's true. No, they don't.
Yeah. Some people want to be a starter at a golf course. Whatever makes you happy. And so you find something you love. It may or may not pay you. Oftentimes people will get paid something, so it's a little bit of additional discretionary spending. So that's generally what, that's generally what retirement looks like these days for people of the baby boom generation who have historically been very dedicated, hardworking, career-oriented people. Many of them are professionals and are intellectually curious. So to put them out to pasture is not something that a lot of people want to do. So they often are looking to do something to stay intellectually engaged. And that's another subject matter is as you're approaching retirement, once you get to 50 years old, and now you're in what I call the retirement red zone for a couple of reasons. A, you are 10 to 15, maybe 20 years away from stopping to work. And you have to do a major financial check. Where am I so far? Am I on track to having the money I require to stop working in 10, 15, 20 years? That's the first thing in the retirement red zone.
Yeah.
The next thing is, if you are an employee, guess what? This is when you often get the pink slip between age 50 and 55. When you become overpriced relative to other members of the labor force. And they say, well, it's just like professional athletes on a sports team. You have the veteran who's earning $20 million a year. Rookie's coming in, we can pay him $5 million, choose your sport. I don't know how good those numbers are. You get the idea. The veteran, the overpriced veteran gets tossed out. The rook comes in and the veteran is stuck now. So as a veteran in whatever profession you're in, or if you're a business owner, but mostly for those people who are employees, you need to be working on your intellectual capital and skill set before you get to age 50, so that if you are forced into a transition, you are ready to do so.
Fair point. But before we go further along those lines, I'm going to back up a little bit. John and Alex, let's go back to this budget because you're in the retirement red zone. Would this be the appropriate time to sit down and lay your budget out and look at it and think, these are going to be my expenses, these are not going to be my expenses, so that you've got a handle on your finances? Is that the way you would do this, guys?
Yes. And ideally you want to do it with a financial professional who's done this many times before to provide you with some perspective. And that's something most individuals are lacking, is perspective. We all get caught up in our little echo chambers and our own little worlds that we function in. But we need a third party, emotionally detached individual who can provide some perspective and context for all of these things. And that will certainly help you make better decisions.
I would even argue, Bill, that it's prudent to try and have that discussion or start planning that out a little bit sooner, because once you get into 50, and as my dad said, you're in the red zone in multiple standpoints. From an employment standpoint, you may only have 5 to 6 years more of top peak earnings if you get packaged out, assuming you're working for a large corporation. And so the reason why I say it might be prudent to do that, to have that conversation a little bit sooner, perhaps when you're in your early to mid 40s, is you need to figure out what that endpoint is going to be. So if, as my dad's outlined here, for a $300,000 gross annual income, you need $7.5 million to retire. That means you need to get to $7.5 million by the time you hit 55, 56, theoretically. Okay. And so depending on your circumstances, obviously. And so that means that you need to be on track to hit that number. And if you do it at 50 years old, that may not be enough time to get you to that number. And that's where some people can get into some very challenging situations. And so it's prudent financially to sit down and have that conversation, even if it's just to get a rough idea, to see what you're going to be aiming for long term. Find out if you're on track to hit that number, and then start making adjustments accordingly in order to try and increase your likelihood of hitting that number by the time period you need it. And so I would say it's a good idea.
So give us an idea in terms of when you look at your budget, because a lot of people have a budget that's in their head that they operate by, but there are a lot of people who don't realize the specifics. So I mean, what are some specific things, guys, that you should be aware of and look at in terms of looking at that budget, and just thinking, the kids still going to be here? Is my mom and dad going to be living? Am I going to need to be supporting them? Those kinds of things.
Yeah, I think that's a great point, Bill. A lot of people tend to underestimate what they're going to need in retirement. Mm-hmm. Speaking with one of my friends, he kept saying to me, "Oh, it doesn't really matter because my spending is going to go way down when I retire." And I said, "Well, hang on a second. That really depends." And I'm sure we've had this conversation before, but I think this is an important time to bring it up again. As my dad said, when you're retired, do you want to sit at home and just sit in front of the TV? Are you prepared to have a decreased standard of living, perhaps, if you don't have the resources to support your current standard of living? For a lot of people, they want to have a better standard of living in retirement. Yeah. They have the time where they're not working, and they want to do things that they couldn't otherwise do when they didn't have that opportunity during their careers. And so that may mean, more free time to spend on, like my dad said, some sort of recreational membership, whether that's at a golf club, a tennis club, what have you. Dining out more. You go and you want to attend some sort of entertainment event, whether that's a sporting event, whether that's, going to concerts, shows, what have you. For some people, it's going to be traveling more. Maybe it's a second home. Maybe you want to have a vacation home. In Canada here, it's very common for people to have a cottage north of the city, especially if you live in the GTA. For some people, it's a second home in a place like Florida. It might be supporting grandchildren, or as you mentioned, Bill, other family members. A lot of people have to care for an elderly parent, but I think one thing that people don't really consider is their children. Even adult children, 35.1% of adult children under the age of 34 still live with their parents.
Wow.
Which
wow,
I think would catch a lot of people by surprise. And an even more drastic statistic is that 91% of Canadians provide some sort of financial support to their adult children. 91%.
Wow.
And so for anybody saying, I'm not going to have to, my kids are going to be adults, they're going to be out of the house, they're no longer my concern. The reality is that's not likely to be the case. The statistics show that more than likely you're going to have to provide some sort of financial support. So you can't just write down that line item to zero. You've got to account for at least a certain amount of money that you're going to want to support them with. And we have in both Canada and the United States, but to a larger extent here in Canada, we have a housing crisis. Very few young adults can afford a house on their own, and so a lot of parents feel the need or feel the desire to try and help their children and provide them with some sort of financial support so they can get themselves into the real estate market. And so those create costs. We've talked in the past about retirement facilities or in-home care. The reality is there's a large portion of the population that is going to require some sort of long-term care when they get towards the end of their life. So for you to just say my spending is going to go down to a third of what it is right now, or even 50% of what it is right now, you don't know. And so that's where it's important to try and create a budget that is maybe a little bit conservative in its nature, and that it overallots resources to your spending in retirement. But it's better to have it and not need it than to need it and not have it.
Oh yeah, no. That's true. It's like when I sit down to prepare a budget, I always figure if I'm going to be putting a number down, it better be a larger number than a smaller number.
Right.
What about, I don't know how it works in Canada, but what about like long-term care options? There's long-term healthcare insurance here in the States, really expensive, got increasingly expensive down here. How about up in Canada?
There were some long-term care options in terms of insurance policies here in Canada. I think a lot of the carriers got priced out of the market. They decided not to offer it any longer.
Yeah.
There's a limited option set for long-term care insurance, and now it's usually tied to the actual life insurance policy. So it's an option or a rider within that, and you pay a premium to get that. So that would be an optimal situation, but that's difficult to get here in Canada. The best thing to do is be prepared. Now, the good thing about Canada is we are not taxed on home ownership assets. So when we sell our home, there are no capital gains tax. I know the current government in Ottawa would like to change that.
Primary residence, just to clarify.
What often happens is people when they get to the point where they need to go into a retirement facility, they will sell their home, invest the money, and then that capital will generate income to help support them in a retirement facility. Where it gets tricky is if you don't want to leave your primary home, but still need in-home care. And then the costs are not cheap. Even just for 4 hours a day, you're talking about $60,000 a year on average to get in-home care. So this also brings up the issue of maybe being able to extract some capital that's dormant in your house. So a lot of people get to the retirement and their house is paid off. Not everyone, but a lot of people. And it would be good to have the ability to draw some of that equity out during retirement to support yourself without having to sell your home. And that brings up the issue of lines of credit. Now, what people who are working don't realize is once you stop working and do not have employment income, banks look at you like you have three heads when you come to them looking for some borrowing. They're going to say, well, how are you going to pay for this? Well, I have a retirement account worth X. They said, yeah, but that's, it's not employment income. So they will give you a really hard time to borrow money when you're in retirement. So the smart thing to do is in that final decade, once you hit age 50, if you haven't already done so, get a line of credit to the maximum capacity permitted. You don't have to access it. You don't have to spend it. Just get it registered and available to you so that when you stop working, they can't ask you to cancel it. And then you have the ability to draw out a certain amount on an annual basis. The other way to fund a retirement is if you have a life insurance policy. Likewise, you can take that to the bank and say, I would like to draw out X amount per year. And the banks have the criterion as to what percentage of the policy's value they are prepared to lend you. You draw out whatever they permit you, and you don't actually have to make any payments toward that. All you have to do is when you pass away, the debt is paid off by the death benefit of the insurance policy. And that's where life insurance policies can become an integral part of the retirement planning process. So it's not entirely about accumulating wealth in your investments. It's also the possibility of accumulating some wealth in permanent insurance. You can't do this with term policies, but you can do it with term to 100 or other permanent insurance policies.
That's interesting. Now let's move to where you started to go, John, in terms of like just being psychologically. So we're financially, we can make an assessment of where we're at and think, okay, I got a good idea we're going to be okay. But I think the bigger hurdle is the psychological hurdle. To be really honest with you.
Yeah, I would agree. It certainly is, and the more typically, this is an issue for people who are small business owners. Professionals, doctors, lawyers, etc., who for all their adult life are intellectually engaged,
right?
And for them to simply get off the bus and do nothing is torturous for these people. They want to be engaged. I know myself personally. I don't know what I would do with myself. I mean, I can only golf a couple of times a week.
It's funny. It's funny you say that because actually I have a friend of mine who retired. He retired early.
Right.
And he moved down to Florida and he plays golf every day of the week. And I have busted his chops and I'm like, how much golf can you play? And he would go, well, I'd play 2 a day if I could.
Well, you know, if I played golf more than 3 times a week, I would probably get an aneurysm and die because the level of frustration involved in that game is beyond comprehension.
Well, he's a scratch golfer, to be fair.
Well, it kind of helps. I guess it helps when you're a scratch golfer. I know I'm not, so maybe it's different for. I'm sure it's different if you're a scratch golfer, but anyway, I think the intellectual engagement plays a big role, and this is why you need to have some alternative activity that is intellectually engaging. Maybe you want to sit on a board of directors committee. Maybe you want to be involved actively in charitable work or counseling younger people, going into perhaps education. In high school, teaching a course, whatever. There are a lot of people who are professionals that could easily get the licensing to teach either at a community college level or high school. So these are things you need to think about. Stress is a big thing. I'm someone who's very cognizant of diet and exercise. But the thing that sometimes we don't think about is stress and what that can do to your body physically in the form of creating harm and health issues. So if you're in a career that is creating an incredible amount of stress for you and it's impeding your ability to get a good 7 hours sleep, then that might be another consideration, is the potential impact on your health, even if you don't want to quit working. And then at that point you say, okay, I love what I do. I want to do it forever, but it's killing me. And
literally.
So,
yeah,
it's killing me literally. And so I need to transition. I need to do something at a slower pace, but that I'm still actively engaged in intellectually. And that's something to give thought to.
It is, and it's great. I like the fact that you brought up the retirement red zone at 50, because then, John, I'm directing this at you as opposed to Alex, because you have time to now start thinking, what is it that I would want to do? You're in that red zone. There are a couple of other things that you need to think about, but it's like one of the things you can start doing at 50 as opposed to, say, 65 or whatever, is what would I do next? What would I do with my time? What are my interests? What are the things that would carry me beyond my career?
So let's take a step back, because right now, and as professional investors, we're constantly referencing financial matters.
Of course, yeah.
The truth, though, is we need to prioritize our health above everything else. What tends to happen between age 25 and 50 is people abuse their bodies, not necessarily intentionally, but they're not paying attention. So they're having a few too many beers during the week. They're having too many bottles of wine. Maybe they're smoking. Maybe they're not getting enough sleep. They're burning the candle at both ends. And what happens is your body can only take so much. And why everyone celebrates their 50th birthday so strongly is because typically that's when the body begins to show its signs of wear and tear. And that might be in the form of heart disease, diabetes, cancer. And so aside from your financial health that you want to be paying attention to, more importantly, you want to recognize that health is critical. You're not going to be able to do anything at retirement. You might not even be able to get to retirement if you're dead. So you need to start thinking about, okay, what do I got to do every day? Is it a 20-minute walk? Get started, 20-minute walk. What do I have to do? Do I have to cut down on sugar and carbohydrates? Then let's do that. But you really need to emphasize your health when you're approaching. I mean, you should emphasize it throughout your life. I'm not saying you shouldn't, but for people who've just been too busy and keep saying, yeah, someday I'm going to start an exercise program. Yeah, someday I'm going to cut back on drinking and sugar. You really need to say, okay, we're here. Age 50, I can't afford to be 50 pounds overweight. I can't afford to keep doing what I'm doing. I need to get my house in order. And that's the first step, is get your health in order. And then once you get your health on track, then you can meet with a financial professional and say, okay, where am I? And where do I need to be? And what speed do I need to travel at? And this is where there's a big controversy in the investment industry. So over the last 25 years, you go to a financial institution, and there's no border between the US and Canada here because they all function the same. You go to a financial institution, you fill in a questionnaire, and they say, you would be most comfortable investing in a portfolio that is 60% stocks and 40% bonds, with the expectation of a rate of return of, say, 5-6% per year.
Right. Yep.
And people say, okay, that's great. So they're investing their money according to what makes them comfortable, without realizing that getting a 5 or 6% rate of return based on your accumulated savings and your expected future savings may leave you short by 50% of what you actually need. And so there's a trade-off between investing comfortably and doing what it takes to succeed. And this is where you have to develop the mindset of an athlete. And that is, what is the end goal? What do I have to do to get to the end goal? Does that mean I have to run as fast as I can and dodge 3 guys before I get tackled? Or does that mean I go for a down and out pattern and step out of bounds so no one touches me? And so you need to make sure that you address getting to the finish line.
Yeah.
And in terms of psychological comfort, that requires some education. You can't just say, well, I don't want to think about these things. The market's complicated and it scares me, goes up and down. No. You have to understand there are certain realities you need to deal with, whether that's real estate, stocks, small business, what have you, and say, I need to do what it takes to succeed, and never mind psychological comfort. That's where you need to get educated in order to gain your psychological comfort, whether that means self-education or utilizing a professional like us to provide that education.
Fair point. Just a really quick amen on the health part. If you take care of your health and you're fortunate, when you get to retirement, your health costs are going to be dramatically lower than if you decided, now I'll do it. Well, no, if you've been doing it all along, you would be very fortunate in terms of the healthcare costs, and it'll cost you less. And the last major point before we get into preparing for the next stage of life is a lot of people just don't feel like they can retire. A lot of people just feel like they can't because of their cost. And so if you get those major costs under control, it seems to me retirement's much more of a reality than you might think it is.
Yes, and that's where you need the perspective of a detached third party to give you that.
The reality is, for a large portion of our population, both here in Canada and where you are in the United States, they don't feel as though they are in that position. And that's where it's really important to be speaking with somebody so you can get yourself back on track if you're not already there. 40% of Canadians aged 15 plus said they cannot afford to retire. In the United States, 22%, only 22% believe that they were confident that they had enough money to sustain them in their retirement years.
Right.
You know, that's a pretty concerning number that it's so small. And so that's where it's really important to start working with somebody as early as possible in order to make sure that you're on track, because the worst thing you can do is wait till it's too late. You know, you come to somebody like us at 60 years old, and not to say that it's impossible, but it's a lot harder.
Makes it a
There's only
bigger
so much we
challenge,
can do. Yeah. There's only so much we can do. We cannot, fabricate money out of thin air. And so it's important for people to get their house in order, as my dad said, be proactive and do it earlier in life rather than later.
So true. It is so true. The other thing, and this is one I'll make a little confession on that I'm tardy with, and that is sitting down to draft up a will.
Mm-hmm.
You can admonish me all you want. Feel free. Having admitted that. But how important is that?
Well, it's critically important, Bill, and I think people have a tendency to overthink this. They start to think about it and they say, "Oh no, I there's this and there's that, and I don't know who, and blah 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 blah." And sometimes the best thing to do is just go and get a very simple will done right away. And then once the simple will is done, you can always spend extra time thinking about it and saying, okay, I want to tweak this and I want to tweak that. But before, everyone's trying to create the perfect document. And you don't need to create the perfect document. Just get something down on paper. As simple as, if I die, my wife gets everything. And after her death, my kids split what's left over equally. And that's your foundational will. And then beyond that, and obviously the wealthier a person is, the more complex it can potentially become, especially if there's businesses involved. But initially you start there. So at least you have something. So if you get hit by a bus or something unexpected, there's something what you don't want. And I don't know about the States, but here in Canada, the government can step in and say, we have this general guideline as to how we distribute assets if you die intestate, and that, which means without a will. And the last thing you want is the government to decide who gets what when you pass away.
Well, yeah, no, there is a saying here in the States, which is exactly what you just said, John. As a matter of fact, when you die, you can either decide where your money is going to go, or the government will decide it for you.
And in that case, the government is never shy about taking their own cut.
Yeah, just some general guidelines for a will. The biggest decision you have to make is who's going to be your executor. And so some people have 3 kids, some people have 2, some people have 1 kid, some people have none. So if you have 2 kids, what you don't want is joint executors, because you can get disagreement, then there's a stalemate, 50-50.
Yep.
What you want is either 1 executor or 3 executors. You want an odd number, so there's always a deciding vote.
Yeah.
Right. And if you only have 2 kids, then find a friend or a professional to act as a third person to make the deciding vote. The truth of the matter is, we as parents all know that not all of our kids are equal in their capability. And some kids are more inclined to be administratively competent than others.
And that's not a fault. That's just a fact.
It's just a fact. Or so you identify your child that has that capacity, maybe with a better education or more inclined to be administratively efficient, and you say, okay, you're going to be the executor. And so you start there. And if you don't have kids, then you can choose a trust company. You can choose a legal firm. Legal firms are good, because especially the big ones, because they can they're not going to die. It's a corporate entity. They can go on and on and on.
Yeah.
But you just have to recognize you're going to pay a fee for that service, and so be it. You're going to be gone. Who cares?
I would even go in so far as to say it's prudent to try and draft some sort of rules around decision making, because even if you have 3 executors, the issue is if they have an agreement that all 3 have to agree, if it's a supermajority situation for any decision, that becomes just as onerous and as tedious as having 2 executors.
On the other hand, I would disagree with that and say that something I learned a long time ago is don't try and manage people's lives from the grave.
No, I understand that, but the problem is that if you have all three have equal authority and all of them have to agree on every issue, if you have three children that do not necessarily get along, that can create just as much gridlock as having two executors.
But that's why I say you should not require unanimity in a decision.
That's all I'm trying to say. Yeah,
that's why you have three, and it's going to be 2 against 1.
Yeah,
you might get unanimity, but if you don't get unanimity, as long as you get 2 against 1, even if as the parent it wasn't a decision you may have made, the truth is it's just is what it is. You're gone, and now it's up to who's left.
But as a parent, I think, John, and you might agree with me here, is that you know the kids, and it's like I would think that, like, recognizing the one most capable of carrying out the duties of an executor, you'd be like, that's the one. We're just going to leave it and we're going to go from there, and they can deal with this after I'm gone, because I'm not going to be here to step in and mediate or get in between things.
Yeah, you don't want to start writing up rules and regulations, because it just becomes too onerous and complicated, and it just creates more stress. And then if you wrote it too vague, and then you need interpretation, then what do? You go to a lawyer and get an interpret? It's just.
So let's go over some of the mechanics of it, Dad. Just first of all, we talked about you mentioned just getting something down on paper.
Yeah.
Yep.
Realistically, how often do people amend their wills, in your experience?
You'd be surprised. Clients generally, they'll get a will down. They won't, and they'll often do it when they're middle-aged, in their late 40s, early 50s, and they may not look at it again for 20 years. But then once they hit about 70 and they start thinking, that's a big number, I'm not going to be around much longer, and maybe I want to review the will. So my experience is that, not the majority, but I'd say a fair portion of the minority are reviewing their will. But it's a good point that you made, and that is to systematically make it a systematic effort to every 5 years review your will. I've heard people say every year. Who's going to do that every year? That's overkill. Every 5 years, or when something changes, if there's a huge life event, there's a divorce, someone in the family dies, whatever, a major health issue, then obviously that's going to trigger a reevaluation. But if nothing happens, then once every 5 years, probably a good idea just to review the will. And it's always good to review it with a professional. Pay your fee to the professional to have that objectivity in the room, and do that.
Okay, so who is typically involved in drafting the will?
A lawyer is involved. The family, the parents are typically involved. The executor is not usually involved. But the interesting thing about executors is, just because you appoint executor doesn't mean the executor will accept that responsibility. They have no legal obligation to accept that. So they could say, well, I know I'm appointed executor, but I don't want to do it for whatever reason, right? So you have to be prepared for that. So you have to have an alternate who can step up. So you may want to think, okay, who are the top 3 people I would consider for executor? Then rank them in order, speak to all of them in advance, and say, listen, I need an executor for my will. Would you be willing to be the executor? And so that, and of the 3 you've ranked, you obviously go with your top choice, but speak to the other 2 and say, listen, I'm putting you down as an alternate. I would like to put you down as an alternate executor. Would you be willing to play that role in the event that the primary executor either can't fulfill that duty or doesn't want to fulfill that duty?
And you're involved in, I'm asking you this because I have not been a part of this yet in my career. But in your experience, have you been involved in drafting the will with somebody, with a client and their lawyer? How often do they ask you to be a part of the conversation?
So we are not, for compliance reasons, permitted to be actively involved in the writing of a will. From time to time, we are asked for some suggestions as to how to how to prepare the family financial portfolio in a manner that is going to help with the parents meet their objectives. And so we can make some suggestions.
Yeah, that's all I'm talking about is, do they ever consult you and say, we'd like to?
Yes, they do consult us, and yes, we give suggestions, but we should not be involved. We should not be in the room with a lawyer and the client. We cannot play that role. It's just it's improper conflict of interest. Yeah.
Okay, Bill, you wanted to jump in there and say something.
Yeah, no. As we're getting to the end of this particular episode, are there any final points that we need to make before we tie this up and put a ribbon on it?
I don't think so. As far as the wills go, POAs was one thing. Dad, do you have any comments about assigning a power of attorney? Because that's something that's generally documented as well.
Yes. So power of attorney is the legal document that gives a person the ability to act on behalf of an individual who's incapable of acting on their own behalf. And here in Ontario, in Canada, there are two separate power of attorney. One is for property and one is for care. And it can be the same person, but sometimes you want separate people for a multitude of reasons. You don't want a non-family member to be in charge of your property. Or at the same time, if you want to make sure no one in the family gets taken advantage of, you just want the property responsibility and the health decision-making separately. You don't want anybody accelerating your demise for their financial best interest, right? So yes, power of attorney is important. Two separate ones. The other thing I may want to mention for people who maintain two residences in two different legal jurisdictions. So, for example, for us Canadians here in Southern Ontario, as noted, a lot of us have properties in Florida or Arizona. And so if you're spending 6 months less a day in Florida and 6 months less a day in Arizona or wherever, you may want to have a local will and local power of attorneys just to reduce the risk of them saying to you, we don't recognize your Ontario legal document, right? So that's something to keep in mind. That's very important.
Those of you who are listening to the podcast, if you're not a subscriber, do that. Subscribe right now. That way, when this next episode drops, you'll be notified and you can give it a listen. But John and Alex, for those of you who are listening and don't know you, and maybe you're thinking it's time for us to have this conversation, or at least for us to start considering things, what's the best way for them to get a hold of y'all in case they want to talk to you?
Best way is to visit our website, which is med-wealth.ca. That's med-wealth.ca. We just relaunched our website. It's been revamped and modernized, so I encourage everybody to go there and check it out. Still has some kinks that need to be worked out, but it overall looks vastly improved from what it used to be.
Fantastic. That is great. And again, don't forget the subscribe part's easy, guys. Just hit the follow button, the subscribe button. That way that's all taken care of, and we'll see you in the next episode. Until that next episode, I'm Bill Tucker, thanking you for taking the time to listen today. On behalf of John and Alex and everybody at MedWealth, thanks for taking the time. We appreciate you being here. If you like the podcast, please share it with other people. Tell folks about it. Tell them you like it and you find it useful. Word of mouth promotion is most welcome. Until next time, I want to remind you, you can go out today and make today a great day or not. It's your choice. Thanks. See you soon.
Thank you for listening to Prescribing Prosperity. Visit our website at med-wealth.ca. That's med-wealth.ca for more information or to connect with us for a consultation. Don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and their guests and does not necessarily represent the views or opinions of IPC Securities Corporation. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investment advice. Always seek the advice of a qualified and licensed financial service provider with any questions you may have regarding your investment or retirement planning. MedWealth Financial Services can provide a private consultation to help you determine the suitability of any guidance discussed on the show.